Okay, let's take a look at a question about warranties. So in this question, Hot Home Inc. offers its customers two furnace maintenance services. One service is for a one-time cleaning and servicing of a home service at a cost of $100. Customers can earn a 5% discount from this price if they pay before Hot Home's calendar fiscal year end for maintenance services to be performed in the following year. The second service offered by Hot Home is a 3-year maintenance plan that sells for $250. The first year's maintenance service for this 3-year plan will be delivered before Hot Home's fiscal year end. No discount for early payment is offered for the second plan. And then it asks us to prepare the summary journal entry for the cash sale of 200 one-time plans for the current year, 100 discounted one-time plans for the following year, and 300 3-year maintenance plans. Okay, so we know we're going to have a cash entry. So we know it's going to be debit cash. But the question is, how much cash are we going to receive? And what's the other side of our journal entry? So is it going to be earned or unearned revenue? Because as we know, we need to record warranty revenue as this service is provided. So if the service isn't going to be provided in this fiscal year, we'll need to record that amount as an unearned revenue liability. So let's do some calculations to figure out what amounts we're talking about here. So it says we are going to have 200 one-time plans. So we're going to have 200 times, and the one-time plan is up here at $100. So times $100. So that's going to give us $20,000. And so this is our cash. But then is it going to be earned revenue? Or is it going to be unearned? So this $20,000 is for a one-time cleaning. So presumably that's all being done this fiscal year. So it's not a delayed service. So we're going to have earned revenue of that $20,000 in this year. Next, we're going to have 100 discounted plans. So it doesn't give us the price of the discounted plan, but it says they'll get 5% off if they pay now and get the service next year. So $100 times 95% is going to give us $95. So we're going to have 100 times 95, which is going to give us $9,500. And we know this is going to be unearned because they're giving us cash now, but the service is going to be provided next year. And so because we haven't performed anything yet, we need to record that as an unearned revenue liability. And lastly, we're going to have 300 3-year maintenance plans. So 300 times, and the 3-year maintenance plan was here, the $250. So that's going to give us $75,000. It's pretty good. And this is a 3-year plan. So it says the first year's service will be delivered before Hot Home's fiscal year end. So we're going to perform 1 year of it now, and 2 years of it we'll need to record as unearned because we can only provide a year at a time. So 1/3 of 75,000 is 25,000, and we're going to have 50,000 here as unearned. So let's total our columns here. We've gone through all the different amounts that we've received and see what our journal entry would be. So the sum of 20,000, 9,500, and 75,000 is going to give us 104,500. The sum of 20,000 and 25,000 is going to give us 45,000 that we've earned, and 9,500 and 50,000 is going to give us 59,500 unearned. So let's turn these numbers into a journal entry. So we're going to go debit cash, and we got 104,500. Then we're going to go credit service revenue. And this is our earn piece. This is going to go through our income statement. It's going to be this amount here, 45,000. And then we're going to go credit unearned revenue, which is going to be 59,500. And this is going to be a liability on our balance sheet. And so that covers off the first part of the question. So we've done A. next, B asks us to determine the balance sheet classification of the unearned portion of the revenue collected. So we know that unearned is this piece. So what we need to know here is what amount of this is going to be earned in the next year and what amount of it is more than a year out. So we know that this 9,500 is going to be provided next year. And we know that 25,000, 50% is next year, and 50% of it's the year after. So when we look at that, we're going to say, okay, so our current liabilities which are services to be provided within 1 year of the statement of financial position are 9,500 plus 25,000, which is going to give us, I believe it's 34,500. Let me just check that. Yeah, 34,500. And our long-term liabilities or services to be provided in greater than 1 year are the 25,000. So, and this 25,000 is the third year of the 3-year warranty. So we're providing 1 year of the service this year, which we've recognized as earned. We have the next year in our unearned revenue that's going to be provided within 12 months of the balance sheet date. So it's still going to be classified as current. And then the third year is going to be provided with 2 years from the balance sheet date. So that's going to be sitting in our long-term liabilities. So that covers off part B. I hope that makes sense. I'll continue going through some more warranty questions in the next tutorial.